All right, thank you everyone for joining in. This is our drill number 6 in which we're going to talk about multi-leg option strategies. Means we'll talk about the strategies which involve more than one leg of an option trade. So when we started our bootcamp journey, we discussed the very basic, or I would say a newbie option strategies, which were cash secured put and covered calls. Both involved only one option contract, with is either you sell a put or you sell a call. Then, so today's session we want to talk about option strategies which involve more than one legs. We had briefly touched upon it in one of the sessions. We looked at the two-legged option strategies. So we'll quickly review those and then we'll move on to other bigger strategies and look at which one to use and when to use. So before we begin, as always, this TLDR this is not an investment, financial, or tax advice. This is for our education and education only, maybe slightly entertainment if you find anything, but definitely this is not a professional advice. So if you are first timer here, anyone first timer? Let me ask again, a few more people joined. Nope, so I can skip this slide for now. Then you already have the links on how you can connect with me outside of these sessions. A quick overview of bootcamp. Hooray, we are done with the first slide of our bootcamp sessions. And now we're moving on to slide number 2. And today we're going to talk about multi-leg option strategies. And then we're going to look at pricing, exit checklist, management techniques, Greeks, and this is where the advanced stage of option bootcamp will start, where we start talking about trade management techniques and the Greeks and the portfolio risk management, and lastly, something from my own experience. So any questions so far on what we have discussed in the beginner session? If you have tried some of your trades, did you have any questions where you got stuck in terms of either the trade execution or how to even make a decision on a particular trade? Cool. Looks like if you don't have any questions, then I will have questions for you. So if you missed previous sessions, as always, go to the website, sign up, go to members bootcamp like this, and you can go and look at the previous recording. I will repeat, like I said in the previous session, it is important that you go through a previous recording before you attend the session. If you had not participated in the previous one, or if you had missed any of the previous ones, all these bootcamp sessions are building on top of the previous one. So if you have not seen 1 to 5, it's better you do that before jumping on to drill number 6. These are progressive drills. We don't directly jump into the most difficult one. We start first with a warm-up, and then we get, increase the level of difficulty as we go along. So same is the case here. So if you have missed some of those, go ahead and view it on the website. Then you will be able to understand the subsequent sessions as well. Multi-leg option trading strategies. All right. So today we're going to look at vertical spread, a quick refresh of that because we already talked about vertical spread in small account trading strategies. We're going to look at strangle. So all these names might be sounding esoteric right now, but if you really look at the breakup of the trade, it's nothing but calls and puts. Then we're going to talk about iron condor, then straddle, then iron fly or butterfly. So let's look at vertical spread. Vertical spread, we call spreads and put spreads. Both have 2 legs, a short leg and a long leg. Means if you are creating a spread, you're selling an excuse me, you are selling an option and you are buying an option. Let's review this table. If you are bullish, again, this is not an optimal. I'm not discussing here which is the optimal way, but just the fact that what strategy can be bullish or bearish. If you are bullish, either you can sell a put spread or you buy a call spread. If you are bearish, we do the reverse. We buy a put spread or sell a call spread. Let's take a quick example. Right, so let's bring up the trading platform. Let's take an example. Say Apple. I am bullish on Apple. I think Apple will go higher than 125. I can sell a put spread 125 to 100. My exposure is only $2,500. So if you look at this trade is profitable if Apple goes higher. I'll be making $447 if Apple goes higher. So this is a bullish strategy. Let's construct the bullish using call side. So 125, I buy a call spread, similar exposure, 150. Now this is a bullish strategy. For this trade to make money, Apple has to move forward. That's why both of them are bullish. Now, as I mentioned during one of the quiz question, if I'm selling a put spread, even if Apple doesn't move, I'll still make money. If Apple moves, I for sure make money. If Apple goes down, I still make money as long as Apple doesn't go below 120.59. So that is why the probability of making money in short put is higher, though the amount is capped. And that's the trade-off. You have a more chance to make money, but you'll be making less dollars every time. The other one, we got a less chance, but lot of magnitude, the amount is higher. But in this case, if Apple stays here, I still lose. Or if Apple goes down, anyway we lose. If Apple goes high, it has to really go make an effort to move beyond 132 for me to make any money. Not 132, it needs to be higher. It is $7.34 is a premium. So it will be 125 strike price. Yeah, beyond 132 to make any money for me. So that's the difference between when you're trying to buy an option spread or you're trying to sell an option spread. It's a trade-off between having a higher probability of making money or a higher dollar amount of making money, but you don't know when you'll make that money. So that's a vertical spread. We discussed more details about it in drill number 5. So you can go back and look into the drill number 5, where we talked about how you can use these vertical spreads to limit the amount of capital that you will be used in trading. The main focus was if you have a smaller value account, what are option strategies you can use. And in that context, we looked at put spread as well as a call spread, that how using these spreads, even with a $20,000 account, even with a $10,000 account, you can trade in Amazon. So if you want more details, go back and review drill number 5. Okay, I see a question. What's the maximum loss for shorting if a stock goes the wrong way? So I'm assuming you're talking about shorting the stock and not a shorting a put or shorting a call option. If you're shorting a stock as such, your maximum loss is unlimited. Stock can go, in theory, it can go to infinity. Okay. All right, I got a clarification. Shorting the vertical spread. So let's go back and look at shorting the vertical spread. If you are selling a put spread, in this case, the width of the put spread is $25. So maximum you can lose is 25, but you already received $4.50. So your maximum loss can be $21.50, which means 2,150. So that's what it shows in, sorry, 2050, 2050. So that's what it shows up in a P&L diagram. I don't care. The stock can go to 80. My loss is capped at 2050. Okay. All right. Hope that helps. Let's move on. Let's talk about the next strategy, strangle. How many legs in a strangle? In a strangle, you have an out of money call and an out of the money put. So this is a two-legged trade, a call and a put. Now we are combining two different type of option strategies. Till now, in a beginner, we only talked about the trades in which we had only one type of option, either call or put. So we had a cash secured put, only one leg in which we are selling a put. Then we talked about put spread in which we are selling a put and a buying a put, but both are puts. Now we're moving on to little more interesting strategies, which is strangle, in which we are mixing. Now we got a call as well as put. And when you do those, an out of money call and out of money put in a single trade, that becomes a strangle. Now, generally, when you're doing a strangle, your directional assumption is neutral. You have no idea whether the stock will go higher or the stock will go lower during the period while your option trade is active, up until the expiration date. So if you don't have any directional assumption, you could use strangle. I know I spoke too many words, so let's look at into the trading platform. Well, let's take an example of which other company. Let's talk about GM. GM was in news today, coming up with their EV plan. Okay, so I know GM was in news. It shot up what, 6.25%. Now I don't know if it will go further higher or lower. But I'm thinking maybe it will stay range bound here. In that case, if I think it will stay range bound, I could do a strangle. So I sell. Now we are talking about. Okay, so all right, let's go through this. So I can sell a strangle, means I sell an out of money put and I sell an out of money call. So it became a strangle. Stock is at 48. I sold a 46 put and I sold a 55. So right now it is not neutral. So for me to make it neutral, it is 48 and 55 is $7 away. So I'll do this around $7 away. So this is a neutral strangle that I sold. So stock is right in the middle of a strangle. In this case, I don't really know where GM will go in, by February expiration. It might stay just in between. As long as it doesn't fall below 40 and go beyond 57, this trade will be profitable. Now I don't have any specific direction outlook for GM. So this is selling of a strangle. I kind of jumped a slide. So when you should buy or sell, if I expect that the stock will move very small, for example, GM. I don't know where the stock will go, but it won't move too much because, hey, it already got so much of a movement in the last 2 days. Maybe it'll just consolidate here. Or it could go a little bit higher, or it go a little bit lower. But I don't expect it to, jump another 15, 20%. Nor do I expect it to just fall down to 30, 35. In that case, and again, this is not my outlook on GM because GM's got earnings coming up. So I won't be doing this trade if I was actually picking GM, because earnings mean it can go up 20%, can fall down 20%. Just an example. So if I'm expecting that the movement for the next 38 days, which is February expiration, is going to be small, I'll sell a strangle. That if you're expecting that the movement is going to be huge, more than what you're paying for, in that case, I could just flip it and buy a strangle. I'm not talking about what is the optimal way. Probably I don't think I ever bought a strangle. Maybe in thousands of trade, maybe 1 or 2 would be buying a strangle, because the amount of money you pay to get into this trade, stock needs to go beyond it. But if you have an outlook, maybe you understand this industry way better than the market thinks, and you think that market has not priced in the amount of a premium that you are paying, the stock will actually go beyond this at expiration. In that case, you could buy a strangle. It means you know that the stock will move beyond your strike price plus the amount of premium that you have paid. So that's why you can buy or you can sell a strangle. Let's look at selling a strangle. We already looked at an example of GM, the previous one, where you sell an out of money put. So stock is at 48, 49. We sold a put at 42, which is out of money. And then you also sell an out of money call. So we sold a call at 55, which is again out of money. The expectation when I'm selling a strangle is that the stock will stay between these two prices. I think GM has moved enough. Now it will consolidate, it will stay between 42 and 55. The premium which I collected provides a buffer beyond the strike prices. Now, if I do this trade, I collect $1.94 as a premium. Say I was wrong and stock actually moves beyond 55. It's okay. I don't start to lose money until the stock has gone beyond $56.94, because that's the amount of a premium which I've collected, $56.95. And that's the amount of a premium I collected. So that gives me a buffer that even if my assumptions were wrong, I can still make money. What's the risk? If you are selling a strangle, the risk is you have a naked call. When you sell a naked call, what if GM goes to 90? What if GM goes to 240? I don't know. It could be, Market has been crazy and some individual stocks have been crazier. So you are exposed to undefined amount of risk because you are selling a naked call. So stock can rise to infinity. So you shouldn't do strangles if you don't know how to manage the position when the call side is challenged. And we haven't talked about option position management. So if you are now gonna do a strangle, don't do it on GMs or don't do it on any of these trades. Don't sell strangle on these individual stocks. And you can't do it if you don't have the highest level of option trading approved. If you have level 2, level 3, naked call selling is not even approved. You need the highest level. In some brokerage firm, it is level 4, some brokerage firm of level 5, or they have a different nomenclature. So you need the highest level of option trading approved to do this trade. And lastly, don't do it on individual momentum stocks. Reason? You are expecting, when you're doing this trade, you are expecting stock to not make huge movements. What happened to momentum stocks? Like, I know this is few people's favorite. Look at the amount of movements it's making. So I'm not going to sell a strangle on this one. I don't care how much attractive the premium may be. And the reason the premium is so attractive is because it's very volatile. So if I were to sell a strangle, I can go down, say $15 low, sell a put, 65, 56, around $15 high, sell a call. It can still get $10 as a premium. And my break-even points in this case is $80 and almost $30. So you might be very tempted saying, come on, QuantumScape is at 56. Probably won't go $15 high or low, but it could. That's why these are the momentum stocks. Who knows? There will be another news that Toyota has started to use, they scrapped their own project and started to use QuantumScape. Or stock may go to 130. So don't ever sell strangles on momentum stocks. This is ideal for the tickers that don't move much, which means no individual stocks. Use it for ETFs. ETFs have a basket of stocks in it. So if one individual company has gone, 20% high, 30% high, it's okay. The overall impact of that on an ETF will be way less than if you had sold a strangle on an individual company. So one of my trading lessons we talked about in Saturday's session, right? When I actually did an introspection of my trading 2020, one of the lessons was I didn't sell naked calls on momentum stocks. I decided I'm not going to sell any naked calls on individual stocks. Only I will do a covered calls, or I'll sell call spread, but I won't sell a naked call. So don't do it on individual stocks. Definitely not on momentum stocks. But you could do it on ETFs. And recently, things like GDXA, XLF, XLB, GLD, EEM, wonderful tickers to sell. This. Look at GDXA. Since August, hasn't done much. Stayed between 62 and 50. And even if we look at an expiration period, let's say next 30 days, 45 days, that's our optimal time to sell an option. It has stayed very range bound. 62, 55, 61 to 54, 52. It's been very range bound. So in this case, I don't even care where it goes. That is why in some of the chat I mentioned GDXJ has been a great hicker for trading for past many months. Every time we made money on this, even though the stock doesn't move, and we still made money because that's the best. You can sell Strangle, and then there are some other variations. So it's a great hicker. Other one we talked about is XLF. Before this rise on last 2-3 days, look at XLF, almost done nothing for 4 or 5 months. Absolutely nothing. And even now, once it went up again for 2 months, very range bound between 30 and 26. So if you look at 30 and 26, that range, now it's what, 33, you can still get a decent premium. Say now it is at 31. So let's go back to the chart. So if I were to sell now I think it's going to consolidate here. We can still get a decent premium on this. If it says between 29 and 34, we're getting 48 cents, which is a decent for 38 days on a stock which is priced at $30, $31. XLB. It's been rising. That's okay. Over a 30 to 45 days period, not much movement. Again, let's look at another 30 to 45 days, another 30 to 45 days, another 30 to 45 days. It's been consistently rising. That's okay. But it's not, suddenly shooting up or suddenly shooting down, except only now. That's when basically it's confirmed that the administration is going to change. So those are the big events. Those are the big either economic events or national events, or sometimes if there are corporate earnings. The best thing I like about ETFs is there are no corporate earnings. So we don't run the risk that there is an earnings announcement coming up, which means the individual stock will suddenly either go up 20% and could fall down 20%. In ETFs, there are no earnings. So that's why if you want to look at a Strangle, look at ETFs. Let's look at EEM, the last one. Same story on EEM. It's always been range bound for next 30-45 days. And we've been playing along EEM all the way through last year. Okay, so let me just finish this one. All right, so let me address some questions. Are stable stocks such as Coca-Cola, MMM, as they fluctuate, etc., are they? Again, the stocks run into earnings season, and the stock has got more risk. What if the CEO suddenly comes under bus? I pray he or she does not, but you don't control that. What if CEO is implicated? What if there's some lawsuit and all that? So individual stocks, that is why I stay away from doing the strangles. I mean, I would still do it because I know how to manage it, but it has got a company specific risk. When you're dealing on ETF, you have taken one huge portion of a risk out of the trade, which is a company specific risk. Now you're only exposed to sector specific risk, which could be, hey, in next 30 days, no one wants to drive gasoline cars. Could happen. Or all the emerging markets, because the dollar has suddenly become strong, all the emerging markets have fallen down considerably. In that case, EEM will do. But one big risk that you've eliminated when you're doing ETFs is a company specific risk. For ETF, better to sell vertical call puts or strangle. Depend on if you have a directional outlook or not. If you have a directional outlook, if you're bullish, then you can use call spreads or put spreads. I will use put spread if I'm bullish. If you're bearish, use call spread. But if you're neutral, you could use strangle, or I'll talk about another neutral strategies. So today, what are we going to talk about? All of them are neutral strategies. So that is why in some of the discussion that I have had, I was like, you don't always have to take a market direction to make money in market if you are dealing in options. If you are dealing only in stock, you have to get the market direction correctly. There is no other way to make money in stock if you don't get the market direction. In options, you can still make money having a neutral bias towards the market. I don't care EEM goes high or low. Only thing I care is it doesn't go high more than $3 or it doesn't fall more than $3. That's all I care. I don't have to take a market direction. I don't have to guess the market direction. I will trade directionless. Okay. All right, any other questions? Okay, look at it. What if you have to buy a strangle? So if you buy a strangle, you do an OTM out of money put and a call. Oh, I forgot which ticker was that, where we already had created a strangle. Was that Apple? Oh yeah. So if we buy a strangle, oh no, this is the call spread. Oh, anyone remembers the ticker? Which ticker did I use previously to create? Oh, GM. Okay. Here I am, it's a strangle, it's a buy. I am buying an out of money call. I am buying at $55. Here, and I am selling a put at $42. Sorry, I'm buying a put at $42. So in both cases, I'm buying a call option, I'm buying a put option, and I'm buying a call option. In this case, I'm still neutral. I don't know, and I don't care which direction the stock will shoot. Either it could blow on the upside, I'll make money, or it shoots on the downside, I'll still make money. This is again directional neutral trade. But because I bought a strangle, stock has to move a lot. If you sell a strangle, stock doesn't have to do anything. The best thing is stock is lazy. But if you're buying an option, then stock has to move. In this case, either it moves on the upside or it falls on the downside. I have both the sides will make money. I don't have any specific direction and I don't know. Example could be in earnings. It's a 50-50 shot in earnings. Stock could suddenly shoot higher. Stock could maybe fall way below. Both case, we have an opportunity to make money if it falls by the magnitude higher than the amount of premium that we have paid. Stock has to get across this hurdle of the premium that we have paid. So expectation, when will I do an strangle? Again, I'm not suggesting, I'm not recommending. Like I said, I probably maybe have done 1 or 2 strangle buys in thousands of the trades. But your expectation is that the stock will move beyond the strike price plus the amount of premium that you have paid. The premium that you have paid act as a hurdle to cross over the strike price. In this case, stock has to go not just beyond 55, but plus $1.95 for you to start making any money at expiration. Use it for the stocks that move a lot, but unexpectedly. And this is a very important word. That's why I put in quotes. We all know stocks that move a lot. Tesla, what, up 6%, 7% today? Up $50. QuantumScape, 20-30%. All these new tech and new love, new darlings of the markets. Neos move a lot. SPACs move a lot. The question is, are those movements expected or unexpected? So you could use, this could work in the stocks that move when nobody is expecting. The reason is, if market is already expecting it, the premium that you pay to get into the stock would be high. So stock has to go beyond that high hurdle. Risk is, you may lose many trades before hitting a home run. So if you keep on doing strangle, and market generally has an idea on how much it moves, the premium get adjusted based on that. So even if you bought a strangle, stock has moved, but it hasn't gone beyond your strike plus premium, you might lose that trade. And you might lose many trades before you hit a big home run. Possible. Not all the years are like 2020. In that case, account may not be able to sustain multiple losses, or your patience itself might run out. So these are low probability, but you can hit it out of the park if you get one shot that will work. But you don't know when that shot will work. Yeah, Plug Power is another one. It's a momentum stock. The Naresh says, unlimited profit if stock goes beyond a range. Yes. It's like a lottery ticket, unlimited profit. You pay money to get into lottery ticket. Beyond that, it's unlimited profit. Okay. So if you really want to do it, maybe momentum stocks. Yeah. But we looked at one momentum stock, which is Quantum Scale. A lot of movement is already priced in, but it could surely go beyond, today for February, market is already expecting that the movement would be around 85. Looking at the option pricing, it's expecting that there is 70% of the time the QS will stay between 85 and 28. Market doesn't know which direction, but 70% of the time till expiration, stock is expected to stay between these two, and the option pricing that you are paying has already been adjusted. So if you are buying this, stock has to go and perform beyond the market expectation. Strike price, generally, if I'm selling a strangle, if IVR is below 30, then I'll do 16 delta. Let's look at, what do I mean by that? Let's look at Apple. Let's look what's Apple IVR, or in this case, this will show IVP. Where's the option statistics? There we go. Is below 30, it's 19. So if I want to do a strangling Apple, maybe I'll go and sell it at 16 delta, closest to 16 delta, which is maybe 110. And 150. For next 38 days, Apple stays between 110 and 150, which is what the market is already expecting. The Apple to stay between these. I'll make what? Close to $300, $275. If I were less than 30, I'll probably look at 16 delta options. Again, you can look at the delta on your trading platform on Thinkorswim. You can see this is a delta 16. I picked up the 16 strike. On the put side delta, we don't have anything 16, so I picked up 30. If IVR is above 50, means the volatility is high, means the expectation is that it will move a lot. It also means that we have more opportunity. In that case, I will become a little more aggressive. I'll do maybe 25 delta. I don't have 25, maybe I'll do 19. And on the put side, I'll do 22. So again, with an experience, you'll figure out what's the right delta for you. This is not a science, but general criteria which I use. Instead of 25, sometimes it could be 30 delta also. Instead of 16, it could be 18, whatever nearest or closest to that what I can find. So that's how I choose a strike price on Strangle. Any question on Strangles? We should use Strangle. You can use Strangle only if you have naked call selling privileges. Even then, don't use it on individual stocks. They have a more propensity to move. Use on ETFs. We have taken one element completely out of ETF, which is a company specific movement or company specific risk. A question says, could you explain again on delta? Today I'm not going to talk in detail on delta. There is whole 1 hour lecture on delta. All I'm saying is, on your trading platform, you should be able to get the information says delta. So when I say I am selling 16 delta Strangle, if I'm selling 16 delta Strangle, I'll pick up the strike price which is closest to 16 delta. Here I don't have anything 16. So I'll pick up say 115, which is 19 delta on the put side. On the call side, I have exactly 16 delta. So I'll sell a call at 16 delta here. Now, why do we pick this? Is a separate discussion. We'll talk when we talk about option Greeks. Delta is one of the most important Greeks. If you don't want to understand other Greeks, just understand delta. It tells you a lot more about your portfolio than we could have ever imagined. Just the delta. All right, any more questions? Let's move on to Iron Condor. Again, you'll see all these fancy names. Nothing difficult. We already talked about Strangle. Strangle had how many legs? There are 2 legs. A call and a put. That's it. Now this is a big brother of Strangle called Iron Condor, which is a tetrapod. It's got 4 legs. It's a combination of a call spread and a put spread. So let's go back to the platform. Let's go to GM. So we had GM. Oh, this is a Strangle. Let's create a call spread and a put spread on GM. Say I want to sell a put spread on GM. I'm selling a put at 30 delta and going $6 below or $5 below and buying a put at 41. So this is $5 wide put spread. Put spread is bullish. Now let me also create a call spread. 50, 55. I also created a call spread. So this is a call spread, $5 wide call spread. Now if I combine these two, this becomes an Iron Condor. Iron Condor is nothing but a combination of a put spread and a call spread. So here you see those individual trades. The first one is a put spread. The second one is a call spread. If I combine both of them, this becomes an Iron Condor. In GM, I don't have the breakup of the pricing on the on the call side. So probably not a good example. Let me go to Apple. Apple is very liquid. There are a lot more pricing, different pricing. So let's do it on an Apple. It was 115 and 110. And if this was 19, and I can go to 145, 150. This is a much better example. Okay. All right. So the moment I combine both of them together, so Thinkorswim will already consider this as an iron condor. So this becomes your iron condor, which is nothing but a combination of a call spread and a put spread. So in this case, I am selling a put spread and I'm selling a call spread. So it means I am selling an iron condor. All the legs are of the same expiration date. So this is iron condor. This is one way to construct iron condor. If you have a Thinkorswim platform, you can just do all of them together by pressing a control and selecting each of the individual legs. Here I selected a put spread. So till now it says only vertical, means it's a vertical put spread. The moment I add a call spread here, Thinkorswim understands, oh, you are adding a call spread and a put spread. It is an iron condor. See, question, condor needs the same spread and expiry. I don't answer the question on same spread. It has got two spreads. It's got a call spread as well as put spread, but both of them are of the same expiration period. Or we just talked about strangle. Because you cannot do naked call and strangle, okay, add a wings to the strangle. So let's do exactly same trade. Did we sell a strangle here? Yes. We sold, this was a strangle that we had sold earlier. 110, 115. But if I don't have a highest level of option trading privilege, or if I am in IRA account where you cannot sell a naked call, how do I trade Apple? In IRA account, I will add in wings to this strangle. So right now I have a strangle on Apple trade. So, but if you look at an iron condor, what does it have? If you forget about this left side and this right side, it just look like a strangle. It is just like a strangle. So what I did on the strangle, you can add another wing. So here I added a wing by buying a call and by buying a put. So either way, you call it as adding a wings to a strangle, or we sold a call spread and a put spread. The end result is we get a iron condor. Now iron condor, because its maximum risk is defined. Even if Apple falls down to $80, you're gonna lose only $365 in this. Or if Apple goes to $190, you're still gonna lose only $365. In a strangle, a risk was kind of undefined. That is why strangle was not allowed in IRA account, or you need to have a highest level of trading privileges to sell a naked call. You can get around with that problem by doing an iron condor. So directional assumption is still neutral. If you look at an Apple, this is like completely neutral trade, or almost neutral, right in the center. Apple can go wherever it wants to go. It can go and meet all its friends, as long as it doesn't go beyond 146.38 or lower than $113.70. This trade gonna be profitable. I have no idea whether it will go up or whether it will go down. All I know is it will stay range bound. Which range, which side, I have no idea. It could go to one, at expiration, it might be at 135, 138. I don't care. Or it could be at 117, 118. Still fine. So this is a neutral trade. Because the strangle was neutral trade, we just added protection on either side in a strangle. So that doesn't change the directional assumption of the strangle. It is still a neutral trade. What's the trade-off? Because let me create a strangle with these strike prices. We had what, 150 and 145 and 110. So 145. Okay, what's the trade-off? In strangle, I can collect $3.35 as a premium. Means I can make $335. If Apple cooperates, it doesn't go bonkers, it doesn't move too much, I can make $335. What's the risk I'm taking? What if Apple moves? What if it goes to 165? What if it goes beyond 150? No, so I'm taking that additional risk, and I'm being compensated for that additional risk by the amount of higher premium that I'm collecting. Now, you reduced your risk. There's no free lunch. You're compensated less. Now you can maximum make $135. But then you don't care where Apple goes. Your risk is limited to $365. So that's the risk and the reward. So when you do a Condor, you earn less in return of reducing the maximum risk. If you had bought it, let's switch it other way around. Let's switch it other way around. If you're buying a strangle, I have to pay $3.35 to enter into this trade. Means Apple has to go $3.35 beyond 145 for me to start making a penny at expiration. Again, everything that we are talking about is at expiration. If Apple moves tomorrow, it moves to 140, of course, you'll make money in this trade. But at expiration, if you're looking at, it has to go beyond your 145 plus the premium that you paid, which is huge, $3.35. But what's the trade-off? You are getting a maximum potential, unlimited potential. If Apple goes to 200, you're gonna ride that out all the way to 200. You're gonna laugh your way to the bank. What's the probability? Probably very less. Now make it to Iron Condor. You bought an Iron Condor. How much you are paying? Paying only $1.35. So you're paying very less amount. Apple has to do less amount of work. Now it has to exceed only $1.35 beyond 145. So your out-of-pocket expense is close to 40%. Only 40%. What's the trade-off? You capped your maximum profit. You cannot make more than 365 in this. Apple goes to 200. You can't make more than 365. So risk and reward. There is no free lunch in investing or trading. If you are giving yourself an unlimited potential, it means you are paying too much. It's like a lottery. We've got unlimited potential, but very less chance of making it, and you're paying through your nose. But if you cap your maximum gain, you are paying very less. So that's a trade-off on Iron Condor and Straddle and a Strangle. Because the protection available, you can do it on individual stocks. Or let's say you may do it on individual stock. You can do it even if the protection is not available, but I suggest you don't do it. But now you have protection available. You may do this on individual stocks. So I do sell iron Condor on some individual stocks because, okay, maybe it made the movements which market wasn't expecting, and Apple gone to 160. Fine, didn't work out this, during this time. It's okay. My loss is limited, and I already know when I put the trade, I already know how much maximum I can lose on this. And if I'm okay with it, I can still sleep peacefully. But if I had just a straddle, which has got unlimited risk, then it will be on back of my mind. What if Apple becomes 180? My loss starts to increase. So in this case, yeah, I can do it on individual stocks because my maximum risk, I know how much I can lose maximum. All right, I'll sip water for some time. Any questions on Strangle or Iron Condor? All right, all good. Still able to hear me? Okay, I did see a question. So, do you need to have a stocks to do a strangle? No, so that is why you need to have a naked call privilege. So in any of these options, there is no necessity to have stocks in your portfolio if you have the highest level of privilege in option trading. And the fact is, on the exchanges, there's a larger number of options traded than the stocks in terms of the notional value. Big houses, the professional traders, they mostly trade options because they don't want to own the stocks. It is capital inefficient. You can create exactly the same profitability profile using options as you will get with a stock. I'll take a quick example. Let me quickly show you, then we'll jump on to the next two. I think might go over 10-15 minutes today. So let's say example of Apple. If I were to, there are too many. Okay. So if I were to buy 128, say 130. If I were to buy 100 stock of Apple, it'll cost me upfront cash outgo of say $130. 30. What's my profit and loss diagram? Ignore everything else. Just pick up this 130. Apple goes above 130, I make money. Apple goes below 130, I lose money. Pretty much familiar with this. We buy the stocks all the time. I buy it at a price, and the stock goes a penny low, I lose money. Penny high, I make money. Let's create similar P&L diagram using options. In this case, I'm getting paid $20. Exactly same P&L diagram. Apple goes a penny high, then 120, I make money. Penny less than 120, I lose money. If I superimpose the stock on it, you won't even see the difference. So I can create exactly the same profile of my portfolio as if I'm holding 100 shares of Apple by doing this option trade. So why do I need to hold stocks? I can just get it using the options. Only thing is, I won't get a dividend here. So if it is the stock doesn't pay dividend, why should I own stock? So most of the professional traders, they don't want to own stocks. You can create everything using options. So why unnecessarily own stocks? It is not capital efficient. I've not reached at that level yet. Still have a stocks in my blood, so I still hold stocks. Slowly, I will get away with it. All right, so let's talk about straddle. Straddle is two-leg trade. In strangle, we had an out of money call. In straddle, we have at the money call and at the money put. So going back to Apple, I love the fruit, so I love the fruit company. So I'm getting examples of the fruit company. So let's say it's close to say 130. So I have a at the money 130 selling a put, at the money 130 selling a call. It becomes a straddle. That's what a straddle is, and this is how it looks like. This looks like a straddle. So selling an at the money put and at the money call 130 is this is called straddle. Directional assumption, neutral, no idea. I don't know whether it will go down or go down or whether it will go up. As long as it doesn't go more than 143,988 or 116.28, I'm going to make money. So I have no directional assumption here. This is more aggressive than strangle. See, if we looked at the previous strangle that I had created, this was a strangle. Okay. I gave myself a lot more room for error. Stock could go down all the way to 148 before the strangle start to lose money. But if I'm more aggressive, I think I don't think Apple is going to move at all. In that case, I could do straddle. I have collected a lot more premium, but look at the amount of risk I've taken. Now my break even is only 143.88. So higher the risk, higher is the reward. No free lunch here. In the strangle, I collected only $3.35 as a premium. In this one, I'm collected almost $14 as a premium. But the moment the stock starts to move, which it will, the amount of a profit starts to go down. And the moment the stock goes beyond 143.82, now it's losing at expiration. So higher the risk, higher the reward, but this is what is termed as a straddle. It has got a use. We'll talk about it. So buy or sell, same stuff, because it's a neutral strategy. If you think it will gonna make very small movements, right, then go ahead and sell it. If you think it's gonna blow through the roof, then go ahead and buy the straddle. Okay. So now many people, they buy the straddle during earnings. So they have no idea which side the stock will go. But they think that, because of earnings announcement, or it will blow up 20%, 30%, 40% higher. Or maybe it will fall down, that much percentage. So there are many new traders who will buy straddle to play earnings. Now remember, if you're doing that, stock has to move at least $13.80 before it starts to make any money. At expiration, if it moves tomorrow, it moves 13.80. Oh, or if tomorrow it moves, say even to $10, oh, you're making some money. You'll make $250. But if tomorrow it moves $5, you're not going to make any money. So this is, I would say, a more aggressive version of a strangle. Reason is, in a strangle, we were picking the strike prices whose delta was 13, 16, or 16. In a straddle, we are picking up the strike prices whose delta is equal to 50. Higher the delta, more is the aggressiveness. Higher put or call, more is the aggressiveness. So that is why you are more aggressive in your outlook, that I'm sure it's not going to move at all. On that case, I will do a straddle. Oops, typo here. This is should be straddle. Sell or short, we all looked at. You sell an ATM call and sell an ATM put. That becomes a short straddle. Stock will make minor movements and will stay within this range. So let's sell it. Stock will have minor movement and will stay within this range. In that case, sell a straddle. The premium collected provides a buffer. Risk is stock can rise to infinity. Same risk like a strangle. Stock will rise to infinity, then it means your loss is unlimited, and hence this is not allowed. In IRA account, you can't do it unless you have a highest level of option trading approved. Again, this is ideal for low price ETFs that don't move much. Now, I do use straddles, again, only in ETFs. Those are like small ETFs, $40, $50. Because in that case, even if it moves high, the loss is not that much. Secondly, is that whether it is a $100 stock, $1,000 stock, or it is a $50 stock, the amount of time that we have to spend in constructing a trade, going and clicking here and constructing the trade and then clicking confirm and send, reviewing it, it's the same. So if it's a very low priced ETF, then if I do a strangle, give me some low priced ETF. Silver is 23. So if I do a 16 delta strangle, its IV is high, so we are getting some good premium. So 15 here, right? I'm making 56 cents. Now, I won't do it on silver because silver, now the silver and gold are expected to move a lot. But in these months, I could have done silver because now I'm making only 56 cents. But I have to, my work input, whether it is $20 stock or whether it's $100 stock, is the same. So to make it worthwhile my time, I will say I would do this. And then I will manage it. So only if it is low price ETF, that you do this. Those which don't move much. Again, I don't think there are too many strangle trades, a straddle that I generally do. You buy it when you expect that the stock will go, it will blow through the roof. So we talked about it already. Any question on straddle? Otherwise, I'll just talk about the modification of a straddle, which is called iron fly. Okay, let's look at an iron fly. Again, this is a four-legged trade. Add wings to the straddle. So this is no rocket science. You understand the strangle, but if we can't do the strangle because I'm not allowed to do naked calls, okay, I'll add wings. I'll add protection. It becomes an iron condor. I'm doing a straddle. I'm not allowed to do it because I don't have a privilege for naked call. I'll add protective wings. It becomes iron fly. Now, there are two ways to construct an iron fly or iron butterfly. Okay, for now, let's look at the adding wings to the straddle. So let's go back, Apple. This is the straddle. Now, instead of this, I had delete. What's the trade? One, okay, straddle 130. selling an at the money put, selling an at the money call. Thinkorswim understands, says, oh, this is a straddle. Now, if I go and buy a protective wing, say $30 out and $30 out, it doesn't have a definition of iron fly. So it'll say it's an iron condor because it's like a call spread and a put spread. But the short call and short put at the same strike. So in iron condor, we have a call spread and a put spread. Here also, we have a call spread and a put spread. My put spread is 130, 100. Call spread is 130, 160. So Thinkorswim say, oh, it's an iron condor. But look at it. This is what this is iron fly or butterfly. Now, in this case, my loss is limited. I bought a protective wings at 100 so that I don't lose anything more if the stock goes below 100. On the upside, I bought a protective wing at 130 so that I don't lose anything more if the stock goes above 160. No, maximum lose at 160 is 1756, wherever it goes after 160. So I limited my losses, and then because I limited the loss, I can do it in a small account. It only consumes $3,000 buying power. If I were to do a straddle, this is illegal plus under. Oh, because I have an IRA. Oh, in this simulation, I have an IRA. I've simulated that I have an IRA account. It says this is an illegal. Yeah, because I can't sell naked call on IRA account. So it's already saying this is an illegal trade. You need to have a plus 100 shares to make it a covered call. So, but it doesn't say anything when I'm trying to do a iron fly. Okay, so this is what an iron fly is. So this is one way is to add a wings. I see a question. If we add 142, 118 protection, what will be the premium? You can add protection, you can change whatever the protections you want to change. But in that case, it is not an iron fly. It becomes, and we'll talk about it. Oh no, I think it will still be an iron fly. Do we have 142 strike? And 118. But this is not even traded. You don't have these strikes for this expiration. Yeah, so you can check what the expiration, and it will show you the premium. You don't have 118 strike here, so you can't do 118. But the premium will adjust based on what are the strike price you pay. Okay, oh, looks like Asif is dropping. Hey, we welcomed Asif. All right, we are just nearing the end. Now, the other way to construct is I can just use calls or I can only use puts. Okay, I actually did that, constructed it in Tesla. Or what's my iron fly on Tesla? $880. Okay. Okay, this is a very tight iron fly. Again, just for illustration, I would never do that. But just a very tight. Oh, no, this is not at 8. It is not centered. So let me create another one. Stock is at 850. Let's create an iron fly at 850. So 850, selling a put, selling a call. Let's say going back to 800, buying a put. 850, buying 850 plus 50, 900, buying a call. So this becomes and iron, what else is selected? This becomes an iron fly centered at 850. Means I'm pinning that the stock won't move more than $50. It is the maximum movement Tesla will get is only $50. So this I've created an iron fly. Now I can also do similar trade by just staying on the call side. And let's take an example of that. We were what, 850. So 850. I'll say buy or sell butterfly. Now I go back and do $50 down, $50 high. Oh, sorry. If I were to construct the similar trade, I will do it. In this case, I've used only the call option. Now again, I myself I found this maybe 2 years or 3 years after option trading, because I was always doing the call using both calls and the puts. But you can do either using calls and puts or only using call or only using put. The result is exactly the same. Doesn't matter. But the terms are different. If you are using a straddle in which you have a short call and a short put and you add a wings to it, it's called iron fly. If you are constructing the same trade using only call, like I've done here, this is called butterfly. So someone asks me, is iron fly same as butterfly? I just say yes, because from a P&L perspective, from how you will manage a trade, what's your maximum profit, it's all the same. So if you look at 45.70 means maximum in this case, if you're using both the call and the put, maximum you can make is 45.70. Here, almost similar. Maximum you can make is 45.70. So, but it's called butterfly. This trade is called butterfly and this trade is called iron fly. Just from I want to throw it out in case you're hearing these two terms. But from a trading perspective, it's almost the same. There are some subtle differences in terms of if you are seeing more volume of open interest, more open interest and volume on the call side as compared to put side, then you may want to stay everything on the call side. In that case, you should just do a butterfly. Or if you are seeing it only on the put side, then you can construct the same trade using only the put side. Let's do that as well. That would be end of the session. So let's do 850, 800, 850 to 900. So we had this call side, have the put side, almost same profile. So it doesn't matter. You can construct it either call or put or call and put. For many years, I only used to do call and put, constructing this. That's what I was familiar with, worked out for me. Now I know about this, but I don't think I actually do this. I still go ahead and do this. So just wanted to throw it out. In case you are hearing iron fly and butterfly, that is the difference. From a trade perspective, not much of a difference. Okay, all right, let's wrap it up. Directional assumption is still neutral, null, because our straddle is neutral. I just added a protective wings here. I earn less or I pay less for getting the protection. So again, there is a risk reward. If you do a straddle, you have a more risk, but then you have a more reward. If you're doing an iron fly or a butterfly, you have a less risk, and so the reward is also less. But because of the protection, If you want to do, you can do it on individual stocks as well. Lastly, some modifications of these strangle straddles. Again, those are fancy names, but those are all constructed out of these basic trades. We have to say broken wing butterfly. That means now this is like a butterfly. The head of the butterfly is here. The wings are flapping here. That's why this is called butterfly. Now, if I break one of these wings, it becomes broken wing butterfly. How do I break this wing? In this case, instead of having equidistant spread, I will change the width of the spread. Now the call spread won't be $50, but say if it is only $20, I'll get less premium. This is called broken wing butterfly. Now this has become from a neutral to a bullish, because now if a stock goes high, I have zero risk on the upside. I reduce the maximum amount of money which I can make, which I would make if the stock just stays here, but I reduce the risk on one side completely. If stock goes now to 1,000, I'll still make whatever $640. So this is called broken wing, because now we clipped the wings of a butterfly. It's only half a wing over here. So if the butterfly got a head, it's going to be half a wing here. It's broken wing. This has got a full wing here. This is called broken wing butterfly. Or I can sometimes skew the strangle. Let's look at a skewing strangle trade. I don't have a strangle here. We have strangle in Apple. So we looked at a strangle trade in Apple. This is neutral. I can skew it to be either bullish or bearish. Means if I, instead of 110 put, if I become a little more aggressive and sell 120 put, now I'm slightly bullish, because now I have a lot more buffer if a stock goes higher. If a stock goes lower, my break-even point is very close. So this is slightly bullish. The previous one was kind of a completely neutral. This is slightly bullish. Now this one is even more bullish. So this is called as a little skewed strangle. You can change any of these trades to suit your exact needs. Are you completely neutral? Are you slightly bullish? You can do this. Or if you're aggressively bullish, you could do this. Now you have, because you are very bullish, you think Apple, it will go higher. I'm certain about it. Then you got a lot more room on the upside. So you can skew any of these trades. Instead of keeping it completely neutral, if you have a slight market outlook, change the strike prices to skew it to suit your market outlook. Instead of bullish, we were bearish, then we would have moved the call down. So that's it. I think this brings us to the end of today's session. A quick summary. In the order of option trading experience, use the strategies in below. Again, if you are completely newbie, just getting started, have a limited amount of privileges, stick to vertical spreads, call spreads, put spreads. As you gain more experience, move to Iron Condor, because Iron Condor gives the stock a lot more leeway to move before it starts to hurt you. Then move to Iron Fly if you are very aggressive, and if you have got an ETF that doesn't move much, then do Iron Fly. Or Strangle and Straddle, you need to have a privilege to sell naked calls. That means you need to have that much amount of experience, or you need to have that much amount of money in your account on $25,000 to $30,000, or less than $25,000, and with only 1 month of an option trading experience. Most of the brokerages won't give the privilege to sell a naked call. As you progress in your option trading, start doing strangles, start doing straddles. All right, that brings us formally to the end of today's session. We ran over 10 minutes. My apologies. Hope this was useful. I know some of you would ask for, hey, when we're going to talk about multi-leg option trades. And again, there is no rocket science behind it. I want to emphasize a lot more on the basics of call option and put option. Once you understand that, you can create any type of multi-leg option strategies. I mean, we talked about 4 or 5. There are trade names like all the animals. We got a zebra trade, zero extrinsic back ratio. Again, that's nothing but a combination of calls and puts. Now, the number of calls may be more than the puts, etc. Those have become ratio trades. There are jade lizard trades. There are multiple trades. At the end of the day, when you start to dissect, it's nothing but a call and a put. So today we talked about the most often used trades or most familiar name trades, which are multi-leg trades. We have more time, we can talk about Batman strategy as well. Okay, any questions? Any copy of quiz to review? Oh, let me see if I can pull the quiz out of Zoom, because I'll have to find that out. It's on a Zoom. Every time I have to go and add it if it's not in the template. Okay, there are a few questions. A lot to learn. Condor, butterfly, extractor. Good night from the East Zone. Good night to you as well. It's I know we ran a little late, so I appreciate you guys staying till late. Can you always close before expiration? Anytime. If you've sold an option, you can close anytime before expiration. Because if you've done an option trade, and the moment you do the trade, stock will start to move. I mean, stock always moves. And if you change your mind, or if you think that the loss is more than what you can think you can bear, close your trade. Then you might have to close it as a loss or at a profit, depending on what the current situation is. But you can always close your trade whenever you want to. And I rather suggest don't let your trade goes all the way to expiration anyway. So next is plan for next session. We're gonna have next Tuesday. I'm getting a little busier in other things, so I don't think I'll be able to do this Thursday. So next Tuesday, what we're going to talk about? Let me just bring up our boot camp updates. Overview. Yes, we're going to talk about option pricing. In terms of how the option pricing works, what are the components of option pricing? What things goes into determining option pricing? So that will be the topic on next session. I'll have to check whether it's a 1 hour or 2 hour. If it is just 1 hour, then I'll maybe add something else along with it. Some smaller sessions that probably not even on bootcamp. But if it's like 15-30 minute session, and this is only hour 30 minutes, then I'll add something to it. But otherwise, I'll do option pricing. It will be on next Tuesday. Oh, you're welcome, Alex. Naresh, welcome. Appreciate you guys joining. Welcome, Leila. All right, any other questions? Welcome, Cheyenne, Tammy. Great that you guys could join. Anyone first timers? No, now these names seems familiar to me. All right, anything else around options? Otherwise, we'll have our regular sessions on Saturday to talk about general market trades, what I'm seeing in stocks and also on crypto market. So that session will continue. So we'll talk about that on Saturday. If nothing else, I think I'll wrap it up right here. Good night, everyone. and I'll talk to you guys again on Saturday.